Did you know that the Tax Cuts and Jobs Act, which was signed by then President Trump in 2017, is set to expire at the end of 2025? That means starting in 2026, if Congress doesn't extend the Tax Cuts and Jobs Act, our personal income tax rates will increase to the pre-2017 level. The standard deduction will be cut almost in half, and the child tax credit will be gone. So is now the best time to start converting pre-tax dollars in the traditional retirement account to a Roth IRA? Before you make that decision, there are some things you need to consider. So reason number one is if Congress doesn't extend the Tax Cuts and Jobs Act from 2017 to the end of 2025, which is only 2 years away, our personal income tax will increase back to the pre-2017 level. So right now, under TCJA, our marginal tax rates are at 10, 12, 22, 24, 32, 35, and 37%. But if Congress doesn't extend TCJA, then the personal income tax rates will increase from 12% to 15% if you're under this income bracket, and it will further increase if your income is more than $44,000 a year as a single individual or $89,000 a year as a married couple, from 22% to 25%, 24 to 28%, and 32 to 33%. 35% marginal tax rate will remain the same, but if you make more than $578,000 a year as a single individual or $693,000 as a married couple, the marginal tax rate will increase from 37% to 39.6%. Not to mention that the standard deduction amount will also decrease significantly, which means that we will end up paying more taxes under the old marginal tax rate system. So to put it in a Roth conversion perspective, you could end up paying a lot more taxes for your Roth conversions starting in 2026. For example, let's say I want to convert $50,000 from my traditional 401k to a Roth IRA. Let's also say my income for the year 2025 put me at 22% in the marginal tax rate. If I multiply $50,000 in Roth conversion by 22%, that would give me $11,000 in total tax bill for the $50,000 conversion, right? But what if I make the Roth conversion in 2026 with the old tax brackets? Because my standard deduction will be cut by almost half, my marginal tax rate could potentially increase to 25 or 28%, depending on my modified adjusted gross income by the end of the year. Just with an extra 3% increase, I would have to pay an extra $1,500 in taxes just for that $50,000 conversion. What if it increased to 28% instead? That would be an additional 6% or $3,000 I have to pay for the Roth conversion, right? So with that in mind, I would seriously consider converting my pre-tax dollars to Roth before the Tax Cuts and Jobs Act is set to expire by the end of 2025. But don't worry, you still have a few years to decide. And reason number two is if you're a high income earner exceeding the Roth IRA income limits, you have the option to make a backdoor Roth IRA contribution. Keep in mind that Congress and President Biden have tried to take away the backdoor Roth option in the past, but they eventually took it out of the retirement bill that was signed in late 2022. Could Congress try to remove the backdoor Roth option in the future? There's always a possibility, depending on who we elect to Congress and the White House, right? But the common misconception is that just because you're over the income limit, you can't put any money into your Roth IRA. There is a loophole that Congress kind of left it in place so that you can do the backdoor Roth IRA conversion. And this is the chart for the traditional IRA. If you're a single individual making less than $73,000 a year, your contribution to your traditional IRA is fully deductible. And if you're married, filing your taxes jointly and have a workplace retirement plan, then you can deduct up to $116,000. If you're not covered by a workplace plan, but the other spouse is covered, then you can deduct up to $218,000. So if you're a high income earner, you're most likely going to be able to make non-deductible contributions to your traditional IRA. So why does this matter? Let me explain to you why. A non-deductible IRA can be converted into a Roth IRA. Again, if you're single, making more than $83,000 a year, or married, making $136,000 a year, then your contributions to your traditional IRA are considered non-deductible in the eyes of the IRS. But you're probably wondering if you can just directly contribute to the Roth IRA instead. You can if your income is less than $138,000 a year as a single individual or $218,000 as a married couple filing taxes jointly. The phase-out range begins at either $138,000 or $218,000. So, and you can check out that chart on the IRS website. But in any case, as long as your income is under those amounts, then you can just contribute directly to the Roth IRA and not worry about making a backdoor Roth IRA conversion. That makes sense so far, right? But if you're making over $153,000 as a single individual, I got the bracket wrong, by the way, that should be greater, as a single individual, and $228,000 as a married couple, then it probably makes sense to make the conversion from a traditional IRA to a Roth IRA. Is that considered a taxable event? It's not, because your CPA should help you fill out a form called 8606 from the IRS to identify that your contributions to your traditional IRA were considered non-deductible, okay? And keep in mind that for every year you miss out on the backdoor Roth IRA conversion with an 8% average annual return, and assuming that you're maxing out the Roth IRA with a 2% average increase in contribution every year, in 5 years, that's almost $43,000 you could miss out on the tax-free investments. In 10 years, that's $109,000 that you don't get to grow tax-free. $371,000 that you could miss out on in 20 years, and over $965,000 in 30 years. And again, we don't know what Congress might do in the future. With this TCJA, Tax Cuts and Jobs Act, coming to an end, they might try to do away with the backdoor Roth IRA option once and for all, okay? And I know this process can be extremely complicated, so I encourage you to get with your local CPA to talk about your current tax situation, or you can always schedule a financial coaching session with me to talk about your personal finances, debt management, and money saving goals by visiting firestarteacher.com/coaching. And reason number 3, you might want to consider converting your money into Roth is if you're expecting to be in a higher tax bracket in your future years. And I know it's hard to predict how much your income is going to be when you're retired or 3 years, 5 years from now, but now is a good time to calculate your estimated tax rates. Some people might have their rental properties paid off by the time they retire, which will put them in an even higher income bracket. But that's probably a good problem to have, right? And another scenario is if your marital status changes from being married filing jointly to single. That's obviously not a good thing to happen to anyone. And I'm speaking from experience as someone who was once divorced. Changing your tax filing status from married filing jointly to single will raise your taxes depending on how high your income is. And the next scenario is if you're living in a state where there's no income tax, but you're looking to move to another state that has a state income tax. For example, I live in the state of Nevada. I'm in Las Vegas, where there's no state income tax. But if I plan to move to California, which I don't plan to, but if I did, my Roth conversion will be taxed much higher than it would if I lived in Nevada. So where you live, when you convert your money into Roth, will matter, especially if you're planning to move to a state where state income tax is considerably high. And reason number 4, you may want to convert your money to Roth is if you're getting ready to retire early from the workforce and have a large pot of money in your traditional retirement account. If you're new to the FIRE movement, which stands for Financial Independence and Retire Early, let me explain how this works. Let's say I decided to retire early at the age of 45 with over $500,000 invested in my traditional 401k. What I don't want to do is convert all $500,000 to my Roth IRA in 1 year, because that will be taxed at the maximum marginal tax rate, right? So what I probably want to do is spread this out by converting $50,000 a year for the next 10 years. For the first 5 years of my early retirement, between the ages of 45 and 49, I'm going to convert $50,000 a year, but I can't make any withdrawals yet because I have to wait 5 years to take the $50,000 out every year, tax-free and penalty-free. That makes sense so far, right? In the second 5 years of my early retirement, between the ages of 50 and 54, I'm going to convert $50,000 a year, and I'm also going to be able to take out $50,000 tax-free and penalty-free every year because of the 5-year rule. Remember the conversion for the 5-year rule, right? I'm going to have $50,000 in tax-free income starting at the age of 50, while I'm still converting that $50,000 every year for my traditional 401k. But keep in mind that I still have to pay my income tax on the $50,000 conversion every year. But because I'm retired, my tax rates will be a lot lower than when I had to work, right? And starting at the age of 55, because I don't have anything left in my traditional 401k by then, I'm just gonna be making the $50,000 tax-free and penalty-free income or withdrawal until I'm 59 years old. And I'm not making any conversions anymore. But that's okay, because at age 59 and a half, I'm gonna be eligible to withdraw from my Roth 401k and Roth IRA tax-free and penalty-free. And I understand that not everyone will have $500,000 invested in their traditional 401k, but even if you just have $100,000 or $200,000 in early retirement, that's one way to have an extra tax-free income stream spread out over several years. But when should you not convert your money to Roth? Let me go over some scenarios. And by no means am I giving you specific financial advice, but these are some things you should consider before converting your money to Roth. If you're close to your retirement and you need your traditional IRA or traditional 401k to cover your living expenses, generally speaking, the Roth conversion might not make sense to you. Remember that every time you make a Roth conversion, you'll have to pay federal and state income taxes. If I need the money right away, then my assets may not have enough time to recoup the taxes I will have to pay inside the Roth IRA. Again, it really depends on your overall income for the year you're going to retire. If I don't have cash on hand to pay the conversion taxes, then it might not be the right time for me to make the Roth conversion. For example, if I converted $10,000 in 2023 and my marginal tax rate for that conversion is 22%, then I would owe $2,200 in federal income tax. If I use my IRA money to pay $2,200 in federal income tax, that's $2,200 that I'm not going to be able to use to accumulate tax-free earnings and interest. Then I completely lose the very purpose of a Roth IRA conversion, right? And if I sell Roth IRA assets to pay the conversion tax for $2,200, since I'm under the age of 59 and a half, I'm going to be charged a 10% penalty and possibly additional state penalties. So if I don't have cash on hand to pay the conversion tax, then it might not be the right time for me to make a Roth conversion. And if you or you have parents or grandparents who are collecting Social Security or Medicare benefits, making a Roth conversion will increase your taxable income, which means your Social Security benefits will be taxed even more and your Medicare costs could rise. Doing a cost analysis could really help you understand whether it's cost effective to make a Roth conversion and how much you should do it, right? Your income tax might still be low enough to make the Roth conversion if the amount is low. It really depends on your total income and how much you want to convert to Roth. And lastly, keep in mind that if you decide to convert your money from a traditional 401k, traditional 403b, or traditional TSP to a Roth IRA, it is an irreversible process. Once you move money from your 401k to your Roth IRA, you can't move it back to the 401k. The IRA gives you much wider investment options, but keep in mind that the earliest you can withdraw from the Roth IRA earnings is not until 59 and a half. So some people choose to keep their money in the 401k because they can withdraw as early as age 55, penalty free. So if you're looking to retire earlier and you need to use your 401k to cover your living expenses, then you should reconsider moving your money to a Roth IRA because you won't be able to touch it until 59 and a half instead of 55. And I know there are a lot of things you have to consider before you convert your pre-tax dollars from a traditional 401k or traditional IRA to your Roth IRA. There are a lot of websites that provide a free income tax calculator. IRS even has one. And keep in mind that if you make a $10,000 Roth conversion this year, then you'll have to pay federal and state income taxes for the same year. If your marginal tax rate is at 22%, then your Roth conversion could make your tax bracket go up to possibly 24%, depending on your income and how much you want to convert. Make sure that you have some cash on hand to pay the conversion tax as well. What you don't want to do is to be completely blindsided by the tax bill that will come around in February or March of next year when you receive that 1099-R. And I strongly encourage you to check out my free financial resources by visiting firesightchat.com/coaching and /resources to get smarter with your personal finances.